I'm the highest earning person in the world in finance.
You're the highest what?
Earning person in the world in finance.
Wow.
In the world.
So explain that to me.
So I'm a hedge fund manager, and I've transformed my fund into a personal investment vehicle because we made such high returns.
In today's video, I'm going to be breaking down hedge funds, what it is that hedge funds do, and how do these guys make so much money. I mean, they make hundreds of millions, if not billions a year, but how do they do it? So, let's start off with the definition. The Oxford Dictionary describes a hedge fund as an offshore investment fund that involves itself in speculation using credit or borrowed capital. If you did not understand, it's okay, because I found a simpler definition online, which I think would be more helpful and informative to break down what a hedge fund essentially is. So, what is a hedge fund? A hedge fund is an alternative investment that uses pooled funds from its investors to employ different strategies in order to generate active returns or alpha for its investors. That's a lot of mouthful of words, but it's fine because I'll break them down. Let's start off with what is an alternative investment. An alternative investment can be considered to be anything that's not mainstream, like equities or stocks. An alternative investment could be real estate, land, currencies, NFTs, art. Honestly, a hedge fund's investment universe is only limited by its mandate. They basically can invest in anything. There's a pooled fund. A pooled fund is when all investors come together and invest their capital in one fund or one vehicle that invests. And what is a strategy? There are different strategies that hedge funds employ, and I'll go over a few later in this video. But a strategy is basically a method of investing in order to maximize returns made on the capital. Now, what is active returns? Active returns is when your portfolio is actively being managed by a portfolio manager. Think of passive returns as you put your money and you just let it sit there. Nothing is being done with it, compared to an actively managed portfolio where there is weights attached to the portfolio. Think the consumer price index. So you have different weights attached to different items in the consumer's basket. Often these weights are being changed according to research or updates, and it's being sold, bought, everything. Now, what's an alpha? An alpha is a bit of a complex thing, but if I was to simplify it and really simplify it, it's the amount or how much better your portfolio does compared to the rest of the market. So say for example, the market return is 20% and your portfolio return is 50%. So essentially your alpha, overly simplified, would be the 50 minus 20, which is 30. So 30 would be your alpha. In layman's terms, a hedge fund is different investors coming and putting their money together in a single portfolio, which is managed by a single portfolio manager who employs different strategies in order to maximize returns in a way that you're able to enjoy high returns in the market. There are a lot of factors that help hedge funds make these crazy returns. To begin with, it can be argued that they're less regulated. So in USA we have something called the SEC, or the Securities Exchange Commission, and in the UK we have something called the Financial Conduct Authority, FCA. But for sure they enjoy more freedom in terms of investing compared to a retail investor or even investment banks. I think a reason for this could be the fact that in order to just invest in a hedge fund, you have to be an accredited investor to begin with. And these authorities believe that if you are such a high net worth individual, then you would be smart enough to not put your money or waste your money or get yourself in very risky situations to begin with. So regardless, these hedge funds often have a bit of cloudiness as to what's going on with them. Often, like I mentioned from the Oxford definition, they establish themselves offshore, for example the Cayman Islands. The reason that they make so much money is because hedge funds have a large breadth of strategies that they can employ, and they also have portfolio managers who have worked in fixed income and equities for 20-30 years. I mean, these are industry professionals. They have kind of mastery over markets, which we could only envy, which helps them employ strategies that we normally could not be able to think of. Another reason they can make a lot of money is because they enjoy a lot of leverage. Arguably, you and I can also get leverage, but the kind of leverage they have is crazy. I mean, I know these portfolio managers who sometimes go 500% leverage, which means a 5x. So if they make gains, they're making 5x, but if they make losses, they're also making 5x, which often a normal investor could probably not afford if they're losing 5 times their money, but these hedge funds can. So they play big, they win big.
Win big, you have to be ready to lose big. And that's what we did today. So you have to be ready for tight decisions. And they go sometimes more often than not against you.
Now let's go over some of the strategies these hedge funds apply to help you better understand how they make money. A very important part of the hedge fund is what we call shorting. Arguably, it's a very important part of the financial world, and it is a sort of complex mechanism, and I could make another video on it, but to put it in a nutshell, short selling is when you borrow an asset like a stock or a bond, and you go ahead and sell it in hopes to buy it back in the future at a lower price in order to repay the loaned asset. Now, if the asset goes down in price, then the hedge fund makes the price difference between the price it sold at and the price it rebought it back in the future, the loaned asset. However, if of course the asset goes up in price, then the hedge fund makes a loss. Like, what is a hedge here? So a hedge is basically a way you try to minimize your loss or risk on a position. So say I'm long a company called Neuralink, which is a brain computer interface company. I think it's gonna do great. What I will do is I will short the rest of the BCI industry, so everything from Neurobell to Synchron, etc. I'm going to go on the opposite direction for the BCI industry, and I will isolate Neuralink because I think that it's going to do well and generate returns. So this means that if Neuralink does well, I will make a lot of money, and I will probably lose money on the other side with shorting the BCI industry. But I hope that the returns from Neuralink are enough to pay off my short position on the BCI industry and still make a lot of money. But what is the hedge here? So say that I was wrong about Neuralink and Neuralink actually goes down in price, then my short position on the BCI industry will help stabilize me and actually minimize my loss. I hope that I can pay off some of the loss made on Neuralink by my short position on the BCI industry. So we can imagine a hedge fund like a pan balance. A pan balance which is slightly always tilted towards the side that you favor, your investment thesis, something that you believe is going to go up or down. And a pan balance still, because in case you're wrong, you don't want to lose everything. But if you're right, you're going to make more money if you're right, you're gonna make more money, basically. Now you may wonder, how can a hedge fund short in the first place? So what hedge funds usually do is use a lot of borrowed money to make these aggressive investments and aggressive calls. And who would loan them money? Well, you go to a big investment bank, say JP Morgan, and the hedge fund will be like, hey, I want to short Neuralink. Now, JP will give them Neuralink and they will go sell Neuralink at a price, but they still owe JP that money. So they hope to buy Neuralink in the future to be able to pay back JP. Now JP does not mind the penalty price because they know how short works, and they also get like a fee or a percentage. It's essentially like a loan from JP, but a loan for betting in the opposite direction of the market. And of course, now if the hedge fund is successfully able to buy back Neuralink in the future at a lower price, then they're making money. If they can't, they're losing money. Now I'll briefly go through a few other strategies that hedge funds employ. So another strategies is long and short equity. The portfolio manager will only invest in stocks and go long and short positions on it. There are various different factors as to how they choose the stocks to be invested in. It could be through quantitative research, or they have algorithms which screen certain companies from the market, and they will only invest in said companies. And There's a lot of different strategies that they could employ here, or a lot of different ways that they could go down, but it's basically long and short positions on equity. There's the market neutral strategy. So do you remember pan balance from the previous example where I said that there's a slight tilt, a slight directional tilt in your investment thesis? Well, in a market neutral strategy, there is no such tilt. So say for example, I believed a certain thing was going to go up. So I would have a longer tilt, which is I would make more money if the market went up compared to the amount of money I would make if the market went down. But a market neutral strategy wipes out this sort of imbalance. Then we have a macro fund. A macro fund has a top-down approach. These managers often prefer very liquid investments like currency forwards. So these macro funds look at very high-level economic and geopolitical events to then work their way backwards into what will happen to stocks and stock markets and adjust their investment thesis accordingly. Then we have something called the special situations fund, which is like it sounds, special situations. Say for example, mergers and acquisitions, or for example, the pandemic. Imagine that they anticipated how big, say, I don't want to get back, would become when the pandemic was just starting. So they invested in those stocks, and those went up exponentially. So it would be a huge profit. At the credit markets, which look at bond rates and interest rates. A final strategy that I'm quickly going to go through is relative value fund. So relative value funds look for arbitrage opportunities, which is basically they try to buy something in one market and sell the exact same thing in a different market at a higher price. Think going to a vintage store and picking up a piece and then reselling it on eBay, hopefully for a fortune. And that's how you make your money. Arguably, they're very low volatility and so now we've covered what a hedge fund is and different strategies they employ to make their investors money. But now let's talk about how they themselves make money. We know the hedge fund billionaire lifestyle looks very attractive. So how do they make money? You might have heard of the 220 rule, which is basically 2% in management fee and 20% performance fee. Although this model is starting to become outdated as more competitive hedge funds are offering 115. But for the sake of this example, let's stick with the 220 rule. So say you have $200 billion invested into my hedge fund, I will charge you a 2% fee, that's $4 million every single year, regardless of whether I make you money or not. Now, what is this management fee justified by? I still have to pay my salaries, my quant researchers, the rental space, etc. for the hedge fund. So I'm going to get $4 million every year regardless of whatever happens. Now let's come to the icing on the cake, or cherry on the cake, or whatever it is. So, which is a performance fee. So say, back to the 200 million example, I make you 20% on your money, which would be on 200 million, so that would be 40 million. I make you 40 million, and as a hedge fund, I'm going to take 20% off the 40 million I just made you, which would be $8 million plus the $4 million that you pay me in management fee. So you get around 28. Yes. It's not a common scenario. Hedge funds usually have billions of dollars under management, which is very, very common. It's very common for them to have billions and billions of dollars. So you can imagine how they can afford those Ferraris and beautiful houses and condos, etc. However, they are very risky. As seen during the 2008 financial crisis, leverage can wipe out hedge funds as well as chunks of the economy. I hope this video was able to break down on a large scale what hedge funds are and how they make money and the strategies they employ. And I hopefully will see you in the next video. You can always comment things that you'd like to watch or something that you'd like me to elaborate on, and always open to constructive criticism. Have a great day.